This is a 40-unit deal. It's on the west side of Atlanta, and it was part of the Opportunity Zone Fund that we put together in 2019. So within that fund, we bought 6 assets, 3 commercial, 3 residential. And this was the second apartment one that we purchased in the portfolio. So we bought it for $1.25 million, which was very cheap in today's terms back then. And then we proceeded to spend the next almost 2 years renovating the entire complex. And in doing so, we gutted everything on this asset. When we first got it, it was this funky blue color, and a bunch of the windows were missing. Typical what we're looking for when we buy something. And you can see this other picture here. We have what the kitchens look like now. We renovated really everything: floors, kitchens, bathrooms, everything on the asset. We put these really cool decks on the back of it as well. We had some other videos as we were doing this renovation just to show what it looked like. But throughout that time frame, every time we do a renovation project, for the most part, we're going in with a 35-month loan. That's our standard community bank lending, this 35-month time frame, and we are coming up on that in March of 2022. So not only this property, but all of the other Opportunity Zone projects that we have, all 6 of them, we're going to go through a similar analysis of what it looks like. And there's certainly some tax components that tie into the Opportunity Zone, and we'll touch on those as well. So overall, we're into this deal right now for about $80,000 a unit. And typically, this 35-month time frame comes up. We have 3 options. Right? It's pretty standard. We can either sell to a new owner, exit the asset, find another deal that we can go look into. We can refinance with the current lender. Typically, our community banks are not long-term lending partners, but they're the fastest and easiest refinance to do sometimes. So we can go that route and refinance with the current lender, or the standard route, kind of like our down the fairway strategy, has always been to refinance with someone like Freddie Mac or Fannie Mae. Kind of depends on the dollar amounts of the loan, but those are the best long-term permanent type lenders. Occasionally, we've done stuff with life insurance companies as well. We did a few deals with Standard Life Insurance Company, but for the most part, we're looking at a federal lender that's kind of right down our game plan of what we do. So we look at the current environment on the Heritage Square deal. When we put this deal together in 2019, we projected that by 2029, complying with all of the Opportunity Zone hold periods and stuff, we were looking for a terminal value of around $4.5 million. That's what we projected the market will get to at that point. So if we think about our operating situation we're currently in, we do have some challenges. There's no asset that doesn't have challenges that we're working through. But here, we have some issues with parking. We don't have fully enough parking spots for 40 units. We knew that, though. We do have some safety concerns on this side of town right now, and we are experiencing delinquency. That delinquency is not necessarily us, but that's more that's what the market is right now. The eviction moratorium stuff, the federal one lifted, but there's lots of other state and local city regulations that are still in place to a varying degree throughout our entire portfolio that we're still working through. And some properties have come out of that faster than others. This one, even though we just leased it up in the beginning of 2021, we still have 13 of 40 residents that are behind. Now, on the financing factors, the current loan we have expires in March of 2022. So we've got to make a decision by then, essentially. And that's a floating rate loan with 25, plus 25 points. And right now, this deal has about 1.12 million of QOZ equity, with the remainder, which is about 16% of fresh equity. Now I have 9% of the total equity is in this QOZ fund, is invested in Heritage. And that's a key point as we look at our analysis here, because in a QOZ fund, 90% of the money has to apply to QOZ, 10% kind of be a discretionary amount. So that 9% here is critical on that part. And then we received an offer for $5 million on this deal, higher than we thought it'd be worth in 2029, at roughly $125,000 a unit. So it was a great offer, but some things are too good to be true. It didn't. They were not able to proceed with that. A mix of many things, from how their financing would have worked to delinquency on the deal to just how everything looked. So that offer, although much higher than anything we had out there, it didn't stick. So that gives us a situation on what does a current capital stack look like? Because remember, no matter what, coming into March of 2022, we have to make a decision on how we're holding this deal, what we're doing within the QOZ fund. And then we're also going to have this same thought process as we look at the other QOZ assets that are coming up for loan renewals or loan expirations that have to have some kind of event. So if we just assume this $5 million market value, and yes, that's probably a little high because we couldn't actually execute anything at that $5 million mark, but that would mean we have about 1.3 million of our current equity. A portion of that is QOZ, and the other part of that is just regular equity. And then our debt, so it leaves us about $1.8 million of valuation gain in this asset at today's, in today's market. So $45,000 a unit. That's pretty darn good. We would have been happy if we'd gotten there by 2029, and we got there 2021, or the market, I would say, got there. So that part means we have a lot of equity, which is great. If we think about this from a refinance situation, as this comes up before March 2022, we're always looking at what can we do to maximize value of the investment. Assuming kind of normal operations and normal delinquency, the property with the rents that we're able to get right now, we've seen great rental growth, we've seen great occupancy here. It would support about a $3.6 million loan. That means we would be able to pay down all of our existing loan. We handle all the closing costs, return all equity and prefs, and have some profit. Now that assumes that all of our tenants are caught up and the eviction moratorium is not in place. With that, well, it's not in place, but with that expiration and how we handle those residents that are there, that certainly impacts what we can do on a loan standpoint. This assumes all that is kind of back to normal, so to speak. So that would be the refinance situation. We'd be able to pull out all of our equity and pay all of our prefs from the beginning of it. And thinking about that from a QOZ standpoint, like that was always the goal with the QOZ, was to be able to refinance these turnaround deals so that we could provide equity. And then, because remember, in 2026, the taxes are due, kind of however we do things, taxes are due on those deferred gains in 2026 in the Opportunity Zone Fund. So now if we look at the sale analysis, the sale part was really based on, hey, we got this offer for $5 million, which was great, very high, and we would be able to make a good chunk of money on that in the Opportunity Zone Fund right now. The tax part of that, like if it's in the Opportunity Zone Fund and it's reinvested in the Opportunity Zone Fund, it doesn't create a taxable event right now. So here you can see the same thing. The closing costs are a little bit higher on a sale. So we'd have our sale value, $5 million minus our old loan, our closing costs, be left with about $3 million of equity. And then our existing equity prefs, and we'd have $1.3 million of profits from a sales situation. Now, all those proceeds that are related to QOZ would stay in the QOZ to be reinvested and avoid the taxes. So now we look at kind of comparing these aspects of what's happening between a refinance and a sale. The QOZ certainly adds a wrinkle to it, right? So if we were to sell something in the QOZ, it's like, it's positive, right? You make a gain, like that's great. Earning extra money is great. There's a small portion of it that's non-QOZ, and that would kind of fall into the regular, whether pay capital gains on that or look to do a 1031 exchange with those proceeds. The cons or the challenges we face with selling something that's in a QOZ is uncertainty on how that tax flows through, right? And then what that deferment looks like to 2026 just adds a whole nother wrinkle into that. Now, with it being less than 10% of the equity in the QOZ, it does provide us with a pretty good buffer. We know that any QOZ fund, that 10% of the equity can kind of be into anything. So, or essentially a non-QOZ or a capital gain or one of those type of situations. So we could accommodate that with this, but that would preclude any other events from happening. On the refinance side, obviously there's no taxes on a refinance. We'd be able to get all of our equity out. It's still cash flows. So there's some definite positives to that. And then the cons are, with a refinance, you're not pulling out all of the equity. So there's still a good chunk of equity that's left in the deal, which would be that roughly $1.4 million that's still in there. The other wrinkle between all of this, as we look at our options, is time. So time is a big driver of how we do these loans within a 35-month period. So when we were talking originally, like, hey, going right down the middle of the path is this federal refinance to a federal lender. That all takes time. We can jump to the next one. So you see that right down the center line is this new lender, Fannie or Freddie. The sales take time as well, and with that sale option, not being real, it didn't actually close. That's kind of off the table, and we're now looking at how do we just extend the loan with our current lender. That provides us flexibility because it's the easiest thing to close. We are typically not seeing large cash outs with an existing lender, but we are able to improve rate and we are able to do it cheaply and quickly. With the loan expiring in March, this one makes the most sense. We're going to try and tackle this in October to see, okay, what is the appetite of this lender that we have here to just extend the current loan. That's typically like a 1 or 2 year extension. It gives us time to settle out with the delinquencies. It gives us also time to improve the rent roll further, and then really reassess if it's a permanent lender option of what the market looks like at that point, or the sale option, what that looks like. But the other part it does is we also have a good chance of locking our rate and not have a floating rate for another 1 or 2 year period. There's lots going on with the movement of 10-year treasuries, which really drives our interest that we're paying. We're kind of always nervous that they're going up. That hasn't been the case for a long time. Josh and I think we've been talking about rates going up forever, and now there's actually an inkling that might happen. So we're trying to get everything we have out of the floating rate. We're always trying to do that, really, and into a locked rate period. So right now we're going to proceed with the current lender and look at extending our loan past that March 2022 timeline, and really give us more opportunity to give the deal time, and then to look at whether we do a permanent refinance or a sale down the road. So we're going to turn it over to Dominique now. We're going to go through what the dates look like as this comes up, and then we're going to open up for some Q&A.
Thank you, Dave, and thank you everyone who has joined. Again, we fully intend to inform the partnership of more hard dates as soon as those are available, but just to leave you with a ballpark range of what to expect and what we have in the works currently. So first, by the end of October, we're really investigating extensions with our current lender. And then by the end of the fourth quarter, we look to review debt options, all to prepare for a target closing by March 2022. So again, folks, those are some quick around the end of the year and beginning of 2022 dates and timelines that we are looking to expect for Heritage Square. I'm going to pitch this over to Kat to discuss any incoming questions that had came through. We did see that many of you used the raise your hand feature. This is a quick reminder to use that, what is the word, Q&A feature located at the bottom of your screen to submit any questions that you may have. All right, without further ado, I will pass it over to Kat.
Thanks, Dominique. So now Dave will answer those questions that you submitted during the presentation. Definitely, please do feel free to continue to submit those as you think of them using the Q&A feature at the bottom of your screen. Let's begin. Okay, firstly, where are we in the refi process?
So the initial steps we're taking right now is just discussing the current loan and the situation of the the performance of the property with the current lender. So as we go through that conversation, that really guides us on what we can expect to get in the fourth quarter here on options with the current lender. We have not taken it to a Freddie or Fannie Mac lending broker either, though.
Okay, next, what does the prepayment penalty look like?
That's good. So on the community banks that we use to be on the construction part, we normally don't have prepayment penalties. They're not the federal step downs of the 5.5, 4.4 percent loans all the way down to 1. We don't have those on our community bank loans. Typically, we do have bank fees, like they'll charge us a fee to do the renewal. That'll probably, it's a little negotiable of between 0.5 point and 1 point or 1% on that transition to the new loan.
Okay, looking at extending with the current lender, does that actually improve cash flow / return to investors?
Not really. It's not going to change our cash flow too much because we would not be looking at doing a cash out situation. And the only thing it does do is optimistically it would help us either lock our rate for a period of time and give us certainty of 1 or 2 more years on the loan.
Okay, next, how will this affect the QOZ fund moving forward?
So right now, if we extend with the existing lender or we do a refinance, it doesn't have any impact to the QOZ fund other than it frees up capital that can then be returned. And then in theory, that money is going to be used to pay taxes in 2026 for our limited partners. That's really what it does. And the next 4 deals we have to go through with this, we'll be assessing that same situation of ensuring that we are able to distribute the taxable basis that's owed by 2026.
Okay, next, since this is in the QOZ fund, will I expect a distribution?
So the investors that are in the QOZ fund, we can only make distributions once we have a basis, and our basis isn't recognized until the 2025 period. So that's we can make debt finance distributions, but otherwise we have to actually earn the money before we distribute it in 2025. So we're not going to have recurring quarterly preferred distributions from this asset, but we can do it with a debt refinance.
Okay, lastly, how will this work for fresh equity investors?
So for the fresh equity part, on the refinance, with the existing lender, there's probably not going to be a return of capital event that happens with that. So there won't be any proceeds really that are going to the fresh equity component from that. But fresh equity can receive distributions from a deal, which is a little bit of a tricky situation because we have technically one LLC, which is the Heritage Square asset, and it in itself can make distributions. Obviously, everything's pro rata, so everything's equal, but Heritage Square LLC is making distributions to the QOZ fund, or it's making distributions to the fresh equity limited partners. All the limited partners with QOZ money, they invested in the fund, which then invested in Heritage Square. So cash flow coming out of Heritage Square can go to fresh equity on just, that's how a normal deal works. But if it's QOZ money, it's going to the QOZ fund, which holds that cash to comply with the tax situation.
Okay, next one in, what are the tax ramifications of the sale? Can you sell and reinvest in other qualified properties?
Yes, you can. So that would be the strategy is if we sold, the proceeds that would go to the QOZ fund would be reinvested in additional QOZ areas to comply with the tax rules. The fresh equity people, if we were to sell it, they would get their money back like a typical deal, and that would either be pay capital gains or use a 1031, depending on what that situation was. We typically offer both on the fresh equity side.
Okay, that looks like those are today's questions. Thank you so much, everyone, for joining us. And now Dominique will go over some important upcoming dates.
Yes, thank you, everyone. This does conclude our regularly scheduled program So we do want to leave up on the screen here those Heritage Square timelines, but also leave you with our Greenleaf Connect upcoming dates. So next week on the 14th to kick off October, we do have a new deal overview for the Family Dollar located in Decatur, Georgia. And then also for our ETC and or IRA investors, we sent out a communication, I believe last week, notifying you and really just letting all of our IRA investors know that we are aware of the Build Back Better Act. And we plan to discuss further through a live stream to have more of a roundtable discussion on how we will move forward with that. So that live stream is to be determined. We will send out event details, registration details, everything, things of that nature, as soon as we have that scheduled. All right, everyone, thank you so much for joining today. Again, this does conclude our regularly scheduled program. We're going to sit here for maybe a few minutes or so if anybody has any other additional questions in regards to Heritage Square or any upcoming opportunities as well. Again, this is a friendly reminder that this live stream is recorded and we will be sharing that with you all via email by the end of the week this week. We look forward to having you on our upcoming live streams and we hope you have a great rest of your day. Thanks, everyone.
All right, thanks, everyone.